I think silver is a better buy right now. Sentiment on gold is just so overwhelmingly extreme. The negative sentiment on gold equities among the broader investment public right now is the worst sentiment I have ever seen in my 50 years managing money in any sector at any time. They think, well, look at all this industrial demand, that's going to carry on. The other thing about silver, of course, is different from gold, is the retail component of demand. 25% of silver production comes from silver mines. The rest is byproducts. Some's byproduct of gold, but some's byproduct of lead or zinc. And the lead miner in Bolivia doesn't stop mining lead because the price of silver collapsed. Dollar's about 80% bullish. The gold miner bull sentiment is about 7% right now. I think this is a good time to buy some more, but I think there's a high possibility, so 20, 30, 40% for gold could easily break the last low, and I don't know what it is right now as we're speaking, but easily break the last low and go down to 3,600.
I'd have to ask you about silver because, I'm looking at it today. It's sold off even harder than gold. But on pure value, forget the hype. Where's the better dollar right now? Is it silver, the metal itself, silver miners?
Well, okay, so first of all, I think gold has better risk reward. There are scenarios, plausible scenarios I can imagine where silver would be hurt more and on a longer term basis than gold. So on a risk reward, I think gold is better. But if you're looking purely at potential, then I think silver is a better buy right now. But the thing people forget about, and I'll answer the question, but the silver miners are dependent upon the price of silver. So we'll start with silver. There's two really important things about silver, and I'm not going to go into all the, everything, but there's two things about silver as an investor, we should really focus on. One is we all know it's more of an industrial metal than is gold, but people seem to think that industrial demand is just forever. No, when the price of something goes up from $10 to $100, what does the end user do? They look for substitutes.
They get creative.
And they get creative and try to use less. And so Chinese solar manufacturers, silver represented 10%. When silver was at $10 or $12, silver represented 10% of the cost input.
Gold and silver markets are entering another critical phase as investors weigh Federal Reserve policy, ongoing geopolitical tensions, and continued central bank demand for gold. While many are focused on short-term price swings, Adrian Day believes the bigger opportunity lies beneath the headlines. He explains why China's changing silver demand, historic pessimism toward gold miners, and long-term fundamentals could create opportunities for patient investors. Let's break down Adrian Day's latest outlook and what it could mean for gold and silver investors.
You didn't really care about it. Was it $10? Was it $12? Was it $15? Who cares? You just buy it and use it. When it ran up to 60, 70, 80, 100, then it becomes very, very meaningful. And so what you find today, you can't substitute anything right now as far as I know. You can't substitute something else for the silver in the solar panel, but you can become more efficient. And so the Chinese manufacturers now, their usage of solar manufacturers, their usage of silver is down about 25%. Meaningful. And you're going to see that in anything and everything. Rick Rule likes to say, I think it's a common phrase in the industry, but the solution to high prices is high prices. And so high prices lead to substitution and to efficiencies in use. And people seem to forget that. They think, well, look at all this industrial demand, that's going to carry on. The other thing about silver, of course, is different from gold, is the retail component of demand. And in January, the gold ETFs were seeing outflows. Right. The silver ETFs were seeing inflows. But when the retail changed, that has an oversized impact on the price of silver. And so it doesn't surprise me that today the silver's gone down more than gold. I think when we get down, I don't know what it is right now, but when we get under 60, 55 to 60, I would think that would be pretty much a low, and I would be looking to be pretty aggressive. But I would always favor in this market, I'm going to favor the equities. The other thing about silver, of course, as we all know, is that there are very few pure silver mines in the world. Something like 25% of silver production comes from silver mines. The rest is byproducts. Some's byproduct of gold, but some's byproduct of lead or zinc. And the lead miner in Bolivia doesn't stop mining lead because the price of silver collapsed. It's only 8% of his byproduct credit anyway. So the supply does not respond to changes in the price, right? Because most of it is byproduct. But that flows over to the companies. There are not that many pure silver companies, whether they're silver producers or silver explorers. You look at Pan American, I think the second largest or third largest silver producer in the world. Last year, 20% or less than 20% of his revenue was in silver. Yeah. But it's Pan American silver. This year with the MAG acquisition, it'll be about, depending on price, of course, it'll be about 23%. So still a minority of their revenue comes from silver. But when and I love Pan American, by the way, I don't want anyone to think that means I don't like it. But when the silver price moves and people are looking for silver stocks, they will buy Pan American silver.
Right. Yeah. Brilliant story, Pan American is as well. Does gold, the wider resource space, does it actually catch a piece of it, or is that just what we're hoping in the room?
Well, I think it will catch a piece of it. It's unfortunate it's coming at this time when the sentiment on gold is just so overwhelmingly extreme. The negative sentiment on gold equities among the broader investment public right now is, and I say this literally, the worst sentiment I have ever seen in my 50 years managing money in any sector at any time. So to illustrate that, they have these bull bear sentiment indices on the gold, on the stock market, on the dollar. The dollar's pretty crowded right now as well. So the dollar's about 80% bullish. The gold miner bull sentiment is about 7% right now, which is, it rarely gets that low. A normal bull bear sentiment index is 60-40, right? By its nature, any market at any time has people who like it and people who don't like it. There's people buying, there's people selling. And so you don't normally get that extreme. But one day, 2 weeks ago, we actually had zero bullish. Now, I joke, well, I wasn't in the sample. They didn't ask me. It's a sample, obviously, but they ask. But I have never seen zero bullish or zero bearish.
Even with the run-up?
Never.
Wild.
Never.
So, let's get practical about where a value investor actually looks then, because, it seems like there's four choices here when we talk about how to play this. The metal itself, we got royalty companies, we got the producers, the junior explorers. After this quarter, in plain kind of categories, you don't have to mention specific names. Where do you see the clearest value right now?
I think there's value across the entire spectrum, to be honest with you. But to me, I would stick with the big cap miners, the good big cap miners, and the big cap royalty companies, because that is where generalist money will first flow. Yeah. So when money first flows back into the sector, because we're seeing these massive withdrawals, right? From GLD and from GDX. Huge. We're seeing these massive ongoing redemptions. But when money first comes back into the sector, unless you're in this room, you don't go and buy AGS Exploration as your first gold stock. You buy Franco or Wheaton or Agnico or Barrick or something, or Newmont. So I think the money will flow into the big cap miners and the big cap royalty companies first. The valuations on those stocks, did you say don't mention that?
Yeah, you absolutely can mention it. The audience would love it.
Well, just as an example, Agnico Eagle, which is a great company, Agnico Eagle had a little bit of a problem last week, and I literally mean a little bit of a problem. Market overreacted. 40 to 80,000 ounces a year for 3 years lost production for Agnico is not a big deal.
But a lot of people to the exit fast.
And we should remember there was no environmental damage, there were no injuries, and most important, the injuries is important, but also importantly, it did not in any way affect the underground development, which is at Odyssey, which is very important. And so to lose 40 to 80,000, 60 to 80 this year, 40 to 60 next, and 2028 8,
Yeah.
it's meaningless. And Agnico actually restated their guidance. They
Makes sense.
yeah.
I mean,
so, but anyway, to get to the valuation, Agnico Eagle today is selling within a hair of its all-time low price to free cash flow valuation. And you can look at other stocks the same. Scotiabank did a study, which a lot of people have seen, and they looked at the top, like, I think it was 20 producers over the last 70 years. And they looked at the valuations, a lot of valuations, price to NAV, price to EBITDA, price to, free cash flow, et cetera, et cetera, et cetera. And on every single one, we are now in the lowest quartile of history. Does not make sense when you've got such incredible cash flows.
Adrian Day believes gold still offers the stronger long-term risk-reward profile, while silver has greater upside potential, but also greater volatility. He warns investors not to assume China's industrial demand will support silver prices forever. As prices rise, manufacturers become more efficient and reduce silver usage, which can eventually slow demand growth. At the same time, most silver is produced as a byproduct of other metals, making supply slow to respond when demand increases. Day also argues that gold mining stocks are trading at historically attractive valuations because investor sentiment remains extremely negative despite many companies generating strong cash flow. Rather than chasing speculative opportunities, he favors financially strong large-cap miners and royalty companies, while encouraging investors to build positions gradually and keep cash available during market pullbacks. For Day, the most important long-term signal remains continued central bank buying, which he believes supports the overall bullish case for precious metals. So what happens if today's uncertainty turns into tomorrow's buying opportunity?
We all get upset about, the price of the price of gold's come down, the price of oil's gone up. When you're Agnico and your all-in sustaining costs last year are less than $1,340, so they go up 10%. It's a negative, but it's hardly the end of the world. I mean, the margins, as you know, are just phenomenal.
It's incredible.
And they won't last. I mean, this is a unique opportunity.
Some value there. And what are your thoughts on the streamers? I mean, they got a little frothy there, I think, of a Wheaton and what have you. I mean, we've seen all these stocks come down on the equity side. Do you wait for a little bit more here?
I think it all depends. And this is why I say I'm not in the business of predicting. If I was in the business of predicting, I'd say, gold's going to do this and you buy today, you buy tomorrow. No. So you've got to look at the individual and their risk reward, their risk reward and their tolerance. Start again. You've got to look at individual investor, what his financial situation and financial obligations in the future are. You've got to look at his risk tolerance. How tolerant is he of risk and volatility? Two different concepts, of course. But the other thing you've got to look at, which is obvious, is how is he already invested? So if I've got a conservative client, and I don't think this violates any SEC rules, if I've got a conservative global account who opened 3 years ago, and I gave that client a 20% gold stock allocation and I bought 20% in gold, well, today, even after the decline, even after me trimming the stocks, that client's now got 35% in gold. Do I buy more today? Of course not. Someone who came in on January and I put some money into the market, but I really didn't want to put it all to work. Well, this is a good time to buy some more. So the bottom line is I think this is a good time to buy some more, but I think there's a high possibility, so 20, 30, 40%, I don't know, but gold could easily break the last low, and I don't know what it is right now as we're speaking, but easily break the last low and go down to 3,600, easily. And if that happens, then of course the gold stocks go down dramatically. So I would invest some today in the biggest and the best, and I would keep some cash on the sidelines, for future better prices.
Still sitting here flirting around 40, 50, something like that. What do you think? How do you actually stage money into this sector so that you're not betting it all on one day's price?
It depends on your time horizon. I mean, if you've got a 5 to 10 year time horizon, You've studied the gold market and you think everything I think and know means that gold will be higher and the commodities generally will be higher in 5 years. Then you have to say to yourself, I don't really care too much about the next 2 weeks. Obviously, it's better to get a better entry point, but if you've got a 5-year time horizon, I would definitely let's say you're just brand new, you just inherited $1 million and you have nothing in gold, you're brand new. I frankly would be looking at putting at least 50% to work this week, at least 50%.
Interesting. Okay.
And I would put it in mostly the bigger cap, the good quality bigger caps, but I would also look at some of the lower risk juniors are out there. Lower risk to me means primarily that they either have a good balance sheet or they have sources of income, or very importantly, they have really strong strategic shareholders. Remember, in this space, most of the companies, with very few exceptions, like say Origin, that has a royalty which is cash flowing, most of these companies have no revenue. If you have no revenue, you're going to have to raise money at some point. And the dilution, equity dilution, is the killer for investments in this space. And so if a company doesn't have a strong balance sheet and doesn't have a source of revenue, well, another source of revenue might be warrants. Do they have some in-the-money warrants that are going to expire? That'll give them an infusion of cash. Yeah. But if they don't have all of that, look to see who owns the shares. If Ross Beatty owns the shares, Rick Rule owns the shares, let me say Adrian Day Asset Management owns the shares, we will be there. We're not charities, but we will be there when you need the capital. I mean, think of it this way. If we own 15% of a stock, I don't want that stock to dilute itself all to hell just so I can get a nice juicy warrant. No offense, Rick. I mean, I want to help. Yeah. We're not a charity, but I want the company to survive and to continue to grow. So look at who owns the company.
You know, this actually is interesting because, I mean, you've been fairly constructive today, obviously, but flip that around. What would you have to see that would actually kind of turn you cautious and move to the sidelines?
On gold, the biggest thing would be a decline in central bank buying on a monthly or quarterly basis.
Yeah, buyers are...
Now, in the first quarter, of course, we saw a huge amount of very high-profile sellers, primarily Turkey, the Gulf states, as well as Poland, Russia. So we saw some very high-profile sellers, but we also saw some buying. And for the first quarter, we had very significant net buying. Yeah. The net buying in the first quarter, despite those high-profile sales, was still higher than the quarter before. Right. April was up on March. So what would turn me really cautious, I mean very cautious, will be to see 1, 2, 3 quarters of net, not a high-profile sale like Turkey, but net
a little
sales.
Right? I mean, it's a liquid asset.
Yes.
Yeah.
That would make me very nervous.
After all these years of kind of running real money through booms and busts, I mean, what is that one rule or discipline that kind of kept you from getting wrecked in the moments when a lot of other people's did?
Well, you say one, there's probably 10 of them.
I was going to say, I'm being kind.
Well, I think one would be, and one is know yourself, and one is know what you're investing in. Know yourself. I can't tell you how many people, when I talk to them, when they're opening an account and I talk to them, oh yeah, I'm fine, I'm a long-term investor. Oh yeah, I'm fine with volatility. I can stand volatility, don't worry. Nobody has ever come to me and said, I'm a nervous Nelly. Yeah. Nobody. So that's the first thing. Look in the mirror and really know yourself. If you cannot tolerate volatility, you need very low exposure to gold stocks because by their nature, they are volatile, very volatile. Don't think you can get around it by using stop losses because you'll get taken out before the bull market's even begun. The second thing is know what you're investing in.
Adrian Day's message is simple. Focus on long-term value, not short-term market noise. Patient investors who stay disciplined may be better positioned when sentiment eventually shifts. What do you think? Will gold continue leading this cycle, Or is silver preparing for a bigger breakout? Let us know in the comments below. If you enjoyed this video, subscribe, turn on notifications, and join us for more expert insights on gold, silver, mining stocks, and the global economy. Thanks for watching, and we'll see you in the next video.